Hi, everybody. Welcome back to Ox Talks. It is Sunday, June 16th, 2024. Happy Father's Day to all the fathers out there. I tried to adjust this camera down a bit so you could see Milo. I thought I would bring him up on the chair with me today. When I'm not sitting in this chair, he likes to be on this chair. We do keep normally like a blanket here so he doesn't get too much hair on it. But anyway, so he's there. You guys can see him behind me. He's kind of got his head buried in the corner. Maybe he'll turn around here in a few minutes with us. I wanted to build on yesterday's show because I was thinking this morning, I saw a couple comments, one of which I'm going to read, which kind of got me thinking about things that I want my experience, my traumatic experience of that foreclosure, which I shared on yesterday's show. I want to be able to use elements of that to help you guys avoid some of the mistakes I made, and also to share with you things that I, looking back, would have done differently. I don't mean necessarily in terms of done differently to avoid getting in that situation in the first place. That's easy, right? Don't don't overextend yourself. Don't make decisions based upon ego or rash decisions with a purchase like that. Get several opinions, even if friends are helping you out. In this case, my team of advisors were people that I knew, right? So in hindsight, I should have gone outside of that group and sought some additional opinions from other people, other realtors, other professionals in that arena about the state of the housing market at that time. And I didn't do that. So that's one thing I would have done. But what I wanted to do was capture more in terms of, once you find yourself in that position where you are either in active default on your mortgage, active foreclosure, pre-foreclosure, whatever it is, then what can you do? And I'm just sharing with you, it's not financial advice, it's not legal advice. I'm sharing with you my experience and looking back now, almost 15 years later, what I would have and what I would now, if I found myself in that same position, do differently. I see the views are great from yesterday. Thank you guys. Please share the video with people, especially the younger generations that are up and coming, looking to buy a house and take on that obligation, okay? Timing is everything. But I'd see that the average view time is about just under 15 minutes from some of the analytics on the video. So look, the video was 47 minutes. I know it was long. I hope I didn't lose people before I was able to deliver the message, okay? Because I was hoping that the viewers, the length of viewing would be a bit longer. I get it though. You guys don't, time is precious. It's hard for, even myself included, to sit and watch a 47-minute video. So I'll try to keep this one shorter. Maybe I'll break it into some additional videos. But let me just start with some statistics on foreclosures and on housing right now, the status of the housing market, as kind of a prelude before I lead into some additional tips and lessons I'd like to share with all of you. Number one, this is it was 2 days ago from Fox Business. Home foreclosures are on the rise again nationwide. And it says, home foreclosures rose again in May as Americans continue to grapple with the ongoing cost of living crisis. That is according to a new report published by real estate data provider Atom, which found that there were 32,621 properties in May with foreclosure filings. And that includes default notices, scheduled auctions, and bank repossessions. Okay, that marks a 2%, I think it says 2%, 3% increase from the prior year, although it's down 7% from the same time last year. May's foreclosure activity highlights nuanced shifts, it says, in the housing market, according to Atom CEO Bob Barber. Quote, while we observed a slight increase in foreclosure starts, the decline in completed foreclosures indicates resilience in certain areas. but it says nationwide about 1 in every 4,320 housing units had a foreclosure filing in May, according to the report. But the problem was worse in several states, okay? So that's just some data I want to share with you. And look at, from my perspective, this is going to continue to cascade in the wrong direction. There's no reason to believe. Number one, if you're already in pre-foreclosure and foreclosure, the chances of you resolving your whatever situation got you there in the first place, finances, bad loan, a drop in equity, maybe negative equity, whatever it is, it's not to be pessimistic, but it's unlikely you're going to simply miraculously be able to unwind that situation and have a huge cash infusion that's going to change that situation. Okay, so again, that's why I'm going to discuss here in a few minutes some things that you might want to consider as you work through that process. The second article was from CNBC a couple days ago. It says competition in the housing market is cooling off, and here's why. And it says more homeowners are listing their homes for sale, but properties are taking longer to sell as potential buyers face high prices and interest rates. Okay, new listings from home sellers jumped in May, up 13% from a year ago, according to the latest market report by Zillow. So look at, listings are increasing and foreclosures are also increasing. What does that tell you? You've got more distress in the market. Okay, you have an increase in sellers coming back on the market, says Orfine Desgovny, a senior economist at Zillow. But with buyers not returning to the market, it says, new listings are just adding to inventory. The number of homes on the market rose 22%, it says, compared with last year, according to Zillow. The market is slowing down. Markets are staying on the market for longer because the sales are not keeping up with the flow of homes coming onto the market. It says almost 2/3 or 61.9% of homes listed on the market in May have been for sale for at least 30 days without going under contract. According to a new analysis by Redfin, about 40.1% of homes that were for sale in May have been there for at least 2 months without going under contract. Market is slowing down. Homes are taking longer to sell, and that allows inventory to accumulate on the market. And look at, as those listings get stale, okay, meaning they're sitting there with no activity, people see that. And that kind of becomes a negative feedback loop for that property. So not to get too much in the weeds on that, but I think you're going to see longer market times. You're going to see more inventory coming on the market. All right. Does that mean that you should rush in and buy a house right now? Again, not financial advice or legal advice. I don't think so. You still have inflated rates and you still have values very, very high. There is, from my perspective, a substantial pocket that values will start to backfill or fall, okay? And, that's the time when you want to potentially step in if you can get good terms on a loan, a good mortgage, you have a solid down payment, and you are you're a good borrower with a good credit risk. All right, you're not overextending. You're not taking on some stupid 0% down or some adjustable rate mortgage product. I'm going to discuss that here in a few minutes as well, because we're seeing mortgage lenders starting to offer all these new programs now to try to incentivize buyers to get back into the market. And that is desperation, okay? That was what was happening in 2006 when I bought my house, and even a couple years earlier. They were offering all these programs, adjustable rate mortgages, the ARMs, 2, 5, 7-year ARMs, 0%, not 0%, but zero money down, meaning 100% financing. They were doing stated income loans where you didn't even have to provide tax returns at that point. You could just show them bank statements and sign an affidavit, and voila, you got a loan. We're starting to see ghosts from the last financial crisis past rear their heads again. So watch what's going on. Pay attention, okay? Don't do what I did. Don't make that mistake, all right? I want to share with you a comment I saw this morning from a subscriber. And this is retired sanitation worker is the name. And he says, it was amazing how fast the real estate frenzy burst back then. I knew a lot of people that lost their homes. Some were neighbors and some were coworkers. I had one neighbor that decided to just quit paying the mortgage and kept living in the house for 2 years until they finally gave him $3,500. The bank gave him $3,500 for the keys to the house. Thanks for sharing your story. Appreciate that comment from a retired sanitation worker, but it raises an excellent point. And that is one of the ideas or concepts I wanted to share with you today. Okay, so we did, I think I perceived the concept of being in default on that property as really a kind of a badge of dishonor. I look at things differently now because look at it's business. As we all know, I read your comments, things do happen. No one's immune from it, okay? So take that as a lesson as well. No one is immune from it. People that say they haven't had hard times or they've only made great decisions are full of crap, all right? We know that. So this was a bad decision that we made. In hindsight, of course, is 2020. We would obviously not make that decision again. We've changed the overall approach to how we handle our finances, personal finances, how I handle the business. But I wanted to share that comment with you because it's important. And one of the things that I did was I felt like it was a failure. And I had failed not only myself, but I had failed the family. And so I was very anxious to disassociate from what I perceived, I think, in my mind to be a loss, right? And so I wanted to get beyond that. But what I didn't contemplate in the interim was we left a lot of benefit or money, if you will, it's money on the table. And to go to that subscriber's comment, I never would have suggested, a lot of people during the financial crisis were stripping the homes or pulling out the last day before the bank came and locked the doors. They were pulling out appliances, stripping, bathroom faucets and all that kind of stuff. That's dishonorable, okay? That's considered waste, W-A-S-T-E. In California, the lender can come after a borrower for committing waste on a property, maliciously destroying it, okay? Or causing it to have even suffer a greater loss of value. So I don't recommend anybody ever do that. However, to that subscriber's or that viewer's point, we easily could have stayed in that house. I knew how long it took to work through the whole process for a couple of years. And again, saving, almost $10,000 a month. That would have been cash in our pocket, money that we could have set aside and then used for whatever purpose, whether it was to pay down other obligations, whether it was to save up for the down payment on the next property, whatever it was. Although that house had a value which was rapidly declining, lower than and declining to a point where the value was much lower, as I shared yesterday, than what we owed on the loans between the first and the second. However, that was a very rash decision and not a smart one. We should have stayed there. I say live for free. I mean, are you freeloading off the system? I mean, in some respects, yes. But look, I will tell you this. The banks are not necessarily your friend. They didn't give a crap about us when I brought them 3 potential short sale options. They poo-pooed that. They wouldn't accept it. They would not work with us in the end. And so we made that decision to turn it back in. A lot may say that was also in and of itself a poor analysis, a poor decision, and I get it. I mean, I can see that looking back now. When you're caught up in the situation, it's different. It's a different analysis. You have emotions running high. You're looking at all these different things, how it is, and going to impact your family, your marriage, your kids, the whole idea of relocating, having the upheaval. But again, looking back, what would I have done differently? I definitely would have stayed in that beautiful, almost 6,000 square foot house for 2 or 3 more years while it worked its way through the process. Basically, not paying on those loans and saving that money. At the end of the day, the result is still the same, and the bank takes the property back. And again, I'll do shows on this if it interests you guys about recourse and non-recourse loans. But basically, if you have a purchase money mortgage, at least in California, if you have what's called a purchase money mortgage, where you used the initial loan money to purchase the property, the banks cannot come after you for a deficiency. Meaning, if the house sells at auction, at foreclosure, whatever, for less than is owed on the loan, the bank cannot come after you for the deficiency. Now, when you have a second loan, that's a different story. There's different nuances there, and the laws are fairly complex. Again, they change from state to state. But a lot of times you are immune from a deficiency judgment by a foreclosed lender if it was called a purchase money loan. In this case, it was because our first trust deed was securing money we had borrowed to acquire the house in 2006. So look, I didn't have any real risk of that, so we should have stayed there. All right. Instead, what we did was we moved out. We uprooted the kids. We moved to a different same obviously area, same part of the state, but moved to a different house and started paying rent, several $1,000s a month of rent. So that was not smart. I should have done that differently and used that time, because the house still had value. It was still an asset, okay? Or maybe even if we felt it important to be out of that environment because of let's just say the stigma of losing the property or having it be in default, maybe even move into something else and then rent the property. It was still my house. It was our house until it went back to the bank 2.5 or 3 years later, okay? So consider that. I appreciate that one comment. And then of course what he said is, 3 years later or whatever, the bank actually gave him a few dollars to move and just peacefully return possession. Because people that don't do that, the banks, like anybody else, they become after the bank forecloses, they become, let me check this mic, guys. Let's go on. They become like a landlord, right? Then they have to go and get an eviction lawyer and pursue an eviction proceeding against you as a landlord-tenant situation, right? And that takes time and money. So the banks, once they wised up, years later, they understood it made sense to get a peaceful and say smooth return of possession of the property after it was foreclosed. What's up? What's up, buddy? So that's one thing I thought that you guys should keep in mind, that you still have an asset there. Second point I want to raise is that in hindsight, we probably did not do enough to save the property. I don't ever recommend that you capitulate if you don't need to. Now, does that mean you go further into debt and make a bad situation worse? Absolutely not. But, consider possibly having some other source of income that you can generate from the property, or doing something to, work it through the process. Try to get some leverage. Again, back in 2006 or 2010, when we went through this, the banks were new to this. They had a playbook they stuck to, and were not willing to work with people outside the box. In years later, they were. As more cases started to come down, legislation, changes in the laws, the banks were much more willing to work with borrowers, okay, as they understood what was happening, and as a lot of those mortgage-backed securities were being challenged in the courts, and remember all those robo-signing documents that were being signed. They didn't have original notes, original documents. So that is also something to keep in mind. I wrote a few notes down here. Stress on family and marriage, all right? Don't underestimate the impact that a foreclosure, just like a repossession of a vehicle or a bankruptcy, will have on your family. If you're married, on your marriage. Tremendous impact. I'm not going to go into that, but I mean, obviously, in this situation, had supportive spouse and kids were fine. They were younger, but it's traumatic. And that kind of stuff, the emotional impact it has and the toll, in hindsight, again, looking back, and maybe should have tried to struggle more, stretch more, find a way more to save it. And some might say, well, you were so far underwater, it was a lost cause. That was my analysis at the point. From a business analysis, just economics 101, this thing was so far underwater, it just made no sense. I thought, well, I'd be paying on this thing for years to come at a high rate, which was about to adjust as well. and it wouldn't have made sense until for that period of time to recapture the negative equity. And so, all I'm saying is I would have taken more time. We quickly basically relocated, and the house sat there. The house sat there, basically vacant for a long time. In California, I'm sure it differs state to state. In California, the banks, number one, they don't start the process of foreclosure formally until they record what's called a notice of default, NOD, notice of default. From the time they record the NOD, the banks have to wait 90 days, at least 90 days before they can schedule the auction sale, the foreclosure sale, which is usually about 30 days from that point in time. So at a minimum, you always have at least 4 months from the time that the notice of default was recorded. But even then, especially nowadays, these banks don't even record the NOD. Sometimes they don't do it for a year, okay? And the more of these that come on the market, become distressed, the more the banks get overwhelmed, and the more time you probably even have in that property before they even start what's called an active foreclosure. All right, the banks are much more, let's say, tuned in now to trying to, let's say, quote unquote, work with the borrowers, pre-foreclosure consultations, try to, maybe put the defaulted amount on the back of the loan. I'm not saying that's beneficial per se, but it's the environment's different now. So if you guys find yourself in this situation, I hope you don't, but it's going to happen. I saw comments to the video from yesterday. A lot of people went through similar experiences, or they had friends or family that did. This wave is starting again, guys, okay, guys and gals. So, history is going to repeat itself, and very, very well maybe worse this time. So if you find yourself in that position, look at some of the other options. Get different input. Don't make rash decisions. These things don't happen overnight. You'd be amazed how many clients I've had consults over the years where clients come in and say, well, can they just come in and kick me out tonight or tomorrow or whatever and change the locks? And it's like, no, there's a process, and it takes time. And if the banks don't follow the process, you have legal rights to stop an improper foreclosure or whatever it is. So again, I want you to be aware of that because it is intimidating. You're already emotionally strung out if you're in default, which means other things happening in your financial situation probably that is causing you stress. And we all tend to make not as smart decisions when we're under that kind of stress. Or more rash decisions. Maybe we act quicker than we need to. And usually in hindsight, those decisions come back to bite you. In our case, it was a smooth transition, but we definitely could have capitalized from a financial perspective to a much greater extent, than we did. Okay. Let's see. Making assumptions about, I talked about this briefly. The zero down mortgage product danger, the adjustable rate mortgage product danger. Those things are coming back out now. They're getting rolled out. That stuff, stay away from it, guys. If you're going to borrow money to buy a house, if you're not a cash buyer, you need to really think about an appropriate down payment so you have the cushion. Some might say, well, keep your money. That's a different school of thought. We could debate that all day as to whether it makes sense to put down less money and use the bank's money. But just understand, if you do that and the value of the property starts to drop, you'll find yourself upside down or underwater on that mortgage very quickly. Now, does that mean the bank can come in and take the house? No, not as long as you're current on the payments. But look, you have nothing there. You have no asset. You have a debt straddling you, and you have no asset if you get into a negative equity situation. So keep it in mind. If you're going to be buying in the near future, these products they're rolling out, you say they did in 2004 and 5 and 6. Always have some kind of a catch. So look at this thing as the glass is half empty, and don't just rely on the opinion of one advisor, one mortgage guy, one realtor. Okay. What else? Other options. Could have rented it. We discussed that. Moved out too soon. It still was an asset that we could have capitalized. Even renting it, even trying to rent it and get some income coming in if we felt obligated to, that we just wanted to be out of the situation. Gave up too soon. I think that's true. I mean, I had a strong balance sheet otherwise, had excellent income coming in. Could we have structured some other options? In hindsight, that may have been the case. I don't know, because I really didn't spend a lot of time exploring it. I was so busy with the practice, and that was just adding stress. So we just kind of capitulated, and that's not really, who I am, especially now. And so give that some thought. If you find yourself in this situation, fight like hell if you can without making the situation worse, okay, to not have to go through that process. I told you yesterday, a foreclosure is a 7-year credit hit. It will destroy your credit. You will not be able to finance anything. You will not be offered credit cards. You will not be able to take advantage of anything else, opportunities that may come your way if your credit is destroyed because you have a foreclosure on your record. Okay. So those were the points I wanted to share with you today. We're already at 25 minutes, longer than I usually go, so I'll leave it there. I got a workout in this morning, Father's Day, a full body workout, and I hope that all of you will, if you didn't do that yet today, get some kind of a workout in, get your steps in, keep that physical fitness regimen as good as you can. Obviously, given whatever limitations that you might have, just move, get the steps in, do some strength training, watch the calories. I got a comment the other day, which I wrote back and said that this person was correct, and she said, Matt, and not all calories are alike, right? So 200 calories from a cookie is a whole lot different than 200 calories, from vegetables or from something else that has some more, let's say, nutritional value for you. Yes, it's calories in, calories out, but you also need to watch the type of calories you're putting into your system. So let's see what happens with the markets this week. Lots going on. I'll continue to do my best to get videos up. Like I said, as I start to think about this real estate stuff and watching this cycle roll back into the fold front and center, I'm going to start dedicating, more shows, not all the shows, but more to this real estate situation. Okay. And with that being said, hope all of you again to the fathers, happy Father's Day. Happy Father's Day to my dad. He'll be coming over here in about an hour. We're going to throw some steaks on the grill. We're going to do some steaks. We're going to do some loaded baked potatoes. We're going to do some corn on the cob, some asparagus. So I'm going to do a little bit extra carb up today, but it's going to be a fun afternoon. Hope all of you have a great day with your family. Happy Father's Day. Have a healthy day, and I'll see all of you this week. Okay, bye.